One of the things about, when markets change, and in this instance, when it's not just the markets, but there are health concerns emerging globally, it's tough to kind of predict or to say what is happening when you're in the middle of a trend. So what we've typically seen is a spate of predictions and prognostications on how things will go. But clearly, one thing is clear is that there's uncertainty. Okay. There is uncertainty, and we'll talk a little bit about what that means, particularly for the banking sector. Let me just make a quick note on, how we saw the last few months post-COVID. Look, around March onwards, when things became quite serious here in the region, naturally, the immediate focus for the center, as well as all of our clients, was to ensure that people were aware and knowledgeable about all of the health risks. That's been a moving target over time, but I think we've landed in a good spot. The right precautions were taken. A number of things have changed, both with us and how we operate, as well as our clientele. I'm sure that'll come up in the conversation. There was clearly the element of stimulus, which happened at multiple levels of the economy, ranging from liquidity from the central bank to a number of financial free zones, including ourselves, supporting firms in terms of payment schedules and fees, etc. I can say, without giving away the store, some relatively well-known observations that for us, from our clientele, this has been a time that has been more challenging for smaller companies than for larger companies. I can tell you that initially in March and April, with all of the uncertainty, many of our private banking and asset managers, particularly for the 10 days where the markets took a 12 to 14% nosedive, that was a moment of significant pain. But since then, the feedback from our clients has been that, for the most part, the fee-based businesses are feeling okay, not bad relative to some of the others. The data is still early, so we will see how Q3 and Q4 look, but year on year Q2, the numbers at the DIFC have been not bad, all things considered. So let me, before I pass on the conversation to Kishan and Saadi, let me just close this forward by saying, what's worked well in the last 4 or 5 months in terms of our engagement is, number one, having open conversations. I think it's really important for us to have that. And you can't have an open conversation unless it's data driven. And I think McKinsey will do a really good job of telling you a story that's based on analysis. And I think that's super important, because when you have uncertainty, there's lots of speculation. Speculation is not bad. It's good to speculate about what might be. That drives a lot of innovation. But I think it's important to be grounded in a set of facts so that the error in your speculation is bounded within reason. And so without further ado, it's my pleasure to give the floor to McKinsey. I think they will provide a very data-driven view. It may come across as serious and occasionally somber, but I think we'll pepper it in with a view on what's next. And thank you again for your time. And over to you, Kishan.
Thank you, Salman. Thank you for the introduction as well. And good afternoon to everyone. It's a pleasure to be here, to be working with the IFC on this topic. So we expect to have other sessions like this in the future as well. So today, I think the goal is to speak a little bit about COVID and how it impacted the GCC banking sector, and in particular the UAE banking sector. I think what we have here and what we prepared for you today is a knowledge research that we did, as you mentioned, Salman. I think we have another presentation on the screen for some reason. So if you could go back to the previous presentation.
If you can allow me, give me back to view.
Yeah. Okay. So what we have prepared for today is a view based on our research and based on previous crises on how this crisis could pan out from an economic and financial perspective, But I think the goal for this piece of research is, as you mentioned, Salman, is to say, okay, if this were to happen, what we should do next, and that's where we would like to end up the discussion and spend some more time. So, and again, I think one caveat before we start is we don't have a crystal ball. So the goal is not to forecast something, but it's just to say, look, based on the economic information, based on the previous crisis, if we were to run the macroeconomic models with the new data, where would we land in terms of impact? And there are different scenarios you will see during our presentation. But the important so what of this whole thing is what we should do next. So without more time on introductions, I'll pass it to my colleague Sadi. Sadi is a junior partner in the Dubai office, and my name is Kishan, and I'm a partner here in the Dubai office as well. And we both work in the banking practice. So Sadi, over to you to take through the initial part of the presentation, and then I'll take over for the UAE's specific impact.
Wonderful. Thank you so much. And hello, everyone. So I think just to set the context, all of us know this is an unprecedented crisis. I think there were 2-3 things which stood out. Number one, I think this was the first crisis where, it's out of the financial system. It was a public health crisis, which had an impact on the economy. And I think an interesting thing about this crisis is that the entire world had this crisis at the same time, unlike, let's say, the previous crisis of 2008, where basically emerging markets were still driving growth and developed world was going through an economic recession. So it's an unprecedented crisis, which has led to unprecedented response. I think all of us know about the responses on the GDP, the stimulus packages, the cash payments, and hence, forecasting becomes extremely difficult for us. Therefore, as a firm in McKinsey, we came up with multiple scenarios. I'll take some time and explain this. So there were 2 metrics at which the way we looked at this crisis. One was how the virus spreads and what is the public health response to control the virus, which is basically the y-axis, and then we also looked at knock-on effects on the economy. And you've seen about the V shapes and the U shapes and all kinds of different possible scenarios. For us, there are essentially 9 scenarios, but I think that if I had to summarize, the scenario A is a slightly more optimistic of the scenario, where we think it's a V or a U shape, and scenario B is a more pessimistic, which is an L or a W. The difference is we did globally a lot of interviews and surveys with CEOs and also in the MENA region, and I think different people have different perspectives. So the percentage is what you see people respond on what they believe would be the possible scenario. An interesting thing to note is when this crisis started, a lot more people, especially in the Middle East and Africa region, they thought A3 is a scenario which is a U or a V shape. However, as the time has progressed, it is coming out to be A1 as a base case, which means that there will be kind of stop, start kind of a way while things will come to normal, and things will not be fully normal till there's a vaccine. So I think this is just to set the context, where are we? And now translating this scenario to the economic impact in the GCC, we looked at what happened in the 2008 crisis, where it was a real estate crisis, liquidity crisis in the market. The output was still there, right? So GCC, which is heavily dependent on oil and gas, petrochemicals, or tourism, there was still economic activity happening. So we saw, in Saudi, a negative 2% growth rate. UAE, Kuwait was slightly hit. Qatar unexpectedly didn't see much of an economic crisis back in the day. But this time around, on the real GDP side, we are seeing a bigger drop, particularly in 2020. And I think the core reason is the Q2 lockdown measures, the 3 months when the industrial output was affected, and the time it's going to bring that supply back to normalization. So I think all in all, it's a slightly bigger crisis compared to the financial crisis, which all of us remember in the near past. Now, what does it mean, in terms of banking, which is the focus of today? I think one important message is that the GCC banks are in a much stronger position than the previous crisis, right? And we looked at some of the metrics to see, why they are stronger, right? So we look at the capitalization levels. Back in the day and today as well, we see the capitalization, which is the capital adequacy ratio, is high for most banks. If you have the same situation in Europe, CET1s or capital adequacies are 12 to 13%. But here in GCC, most banks are pretty healthy in terms of capitalization level. The loans to deposit ratio is also an interesting one. It is similar to the previous crisis, but slightly better, especially when it comes to UAE, where back in the day there was a lot more reliance on foreign liquidity, which went out as the financial markets crashed. So liquidity is better, capitalization is better. The banks are more uh, better cautious in terms of taking provisions. And I think the thing which stood out for me was, the starting position of the interest rates, right? So in 2008-9, the interest rates were hovering around 5%. So when they dropped to 0%, suddenly there was a big drop in the revenues. This time, I think the market started at 2.8, and now they're at 100 basis points. So there has been a lesser decline in the interest rates, which will put less pressure on the revenue of the bank. So all in all, it is banks from a revenue point of view are less affected, from a structure point of view less affected, but the knock-on effects of NPLs and the loss in businesses is still the biggest threat. And that's what basically help us make some of the projections for 2020 and beyond. What we think is that across the GCC, be it KSA, UAE, Kuwait, or others, we see a drop between 20 to 30% in the revenue after risk cost. And essentially, there are three reasons. One, I think there's a decline in margins. Second, I think the biggest one of all is the rise in NPLs. And thirdly, I think the new business slowdown is also right, which is reflected in our assumptions for lending growth and deposit growth. So be it the commercial banking, you're looking at corporate SME, or you're looking at the more interesting asset management businesses, or investment banking, there is going to be a slowdown in uptake, which is basically going to cause this decline in the revenue. We'll also soon talk.
Kishan, sorry, could you just move the gray box? I think some of the attendees can't see the deposit growth section on the presentation. Thank you. Yes,
Yeah.
thank you so much.
But structurally, I think
the gray box, I think it's the image, right? It's still there, but it's your okay. Can you do it further? One more, a little bit more. Yeah, perfect.
Yeah. On the lending growth, we see there will be still demand for credit as companies will be cash crunch. It will slow down, but there is demand. Banks will also be a bit resistant, so there's a supply side problem as well. Deposit, I think we see a bigger issue, and that's why, as there are job losses, people going out of the sector, the government deposits declining because of oil prices. So there's also a bigger issue on the deposit side. So just 1 second. So basically, what happens to the structure of the banks then? So we see basically liquidity. It won't be a bigger problem compared to the financial crisis, but the loans to deposit ratio will increase as the demand for credit is more. The bigger issues are on the profitability measures. We see, somewhere between 400 to 500 basis points reduction on the return on equity and a reduction in return on asset driven by the provisions. And there will be capital decrease given by the downgrades and NPLs, but it is not going to be at a level where there's going to be a capitalization problem in the sector. So that's basically, in a nutshell, what we think as an impact. The impact is already reflected in the market capitalization and H1 results. So here is a quick view of H1 results. In H1, 6 months, Saudi Arabia has seen roughly a 15% drop in revenue after risk cost. I think an interesting thing to note here is that, there has been a margin decline, but the demand for deposit and particularly mortgages in Saudi Arabia has been growing because of the Vision 2030 initiatives. UAE has seen a bigger drop, essentially because their banks have taken a lot more provisions. The other countries might take provisions in basically near future, but UAE has been more proactive in taking down the provisions. So I think our forecast was between 20 to 30%. We are in line almost when it comes to H1 results. But the good news is, when we look at the GCC banks, be it the UAE, be it the Saudi Arabia or Kuwait, the impact on market capitalization is less than the developed markets, be it UK, France, US. And the underlying reason is, there are two reasons for us. One, I think the economy is much more protected. So the national companies here are a lot more government owned, which are protected. Two, I think, especially in the context of Saudi Arabia, a lot of the retail jobs are in public sector, and which basically is a steady income flow versus the UAE where it's a lot more expert heavy. So yes, long story short, there is a big impact, but lesser than the impact we have seen in the rest of the world. I think that's pretty much at the structural level what we see now. I would ask my colleague Kishan to go deep in UAE and then tell us about what are the actions bank can take to resolve or address this crisis.
So Sadi, thank you very much. Can we just stay 1 second on the previous slide? I think one interesting fact is that we've done this research for mostly the whole globe, right? So we have estimated the banking the impact of COVID in the banking sector for most countries around the world, and what we see is that I think a lot of the geographies where we see a bigger impact on the market capitalization of the banks are also those where, one, the retail size of the total revenue pool is bigger, and second, there is an expectation of a significant job loss and impact on basically the NPLs on the retail side. While, as Sadi mentioned, in the GCC, we expect this impact to be somehow mitigated because, one, the retail segment is not the biggest contributor to the revenue pool, and second, a lot of it we expect it to be somehow protected from especially the job loss impact to be mitigated. So Sadi, if you could go next. Now I think what we walk you through is a UAE specific view, and I think the first message is that what we see here is basically revenues before risk and revenues after risk for the different crises. And what we expect is, as it was mentioned, that both before risk and after risk will see an impact, but we expect a steeper impact on the after risk revenues than we saw on the previous global in previous crisis, in particular the global financial crisis. And so we are talking about a 10% drop in revenues before risk and about between 28 and 34% on after risk. I think one point to take into account is that typically in this crisis, the risks are very difficult to pinpoint in terms of exactly in which year they will happen, right? They might be somehow pushed to 2021, and so I think it's always important to look through the crisis through the 2 or 3 year period instead of just 1 year period. Still, I think from what we're seeing on the H1 results, I think unfortunately the 30% after risk impact is likely to be seen, in particular in the UAE. Sadi, if you could go to the next page. I think this point was mentioned by Sadi, and I think it's very well reflected in this slide, is that the margin impact will be smaller when compared to the global financial crisis, because we are starting from a much lower interest rate level. But I think where I think the big question mark, and where I think if at the sector level and at the regulator level, I think the thing to really look at carefully is the risk costs. And in a do nothing scenario, which is what we presented here, what we mean is a do nothing scenario is if there aren't clear measures from the regulator, from the government to support some of the most impacted sectors, this is what we would see. I think the good news is that we are starting to see a number of measures to mitigate this impact. So our hope is that not all of this risk impact will be seen at the bank level. So if you go to the next page, Sadi, I think we just have the breakdown of the lending risk costs by the three main product lines in the country, right? So we're talking about consumer finance, mortgage, and the wholesale lending. And I think which is the black line here. And if you look at the black line here and we compare it to the financial crisis, what we're saying is that we would see risk costs very similar to the financial crisis. And I think this is the main curve to look at, because as I told you in the beginning, the dependency of the banking sector on the corporate or the wholesale revenues is very meaningful, and a significant part of the portfolio, a very large part of the lending portfolio of the country is for corporates. So if I had to monitor and look at one line, obviously this is not stated in the bank results as separately, so we don't know exactly what is happening. But I'm sure that at your bank level and at the sector level from the regulator, you can have this level of detail. The curve to look at is this black curve, and hopefully we don't get to the same risk in wholesale risk levels that we saw in the previous financial crisis. If we go to the next page, the next page basically just summarizes where the lost revenue is going. By lost revenue, we mean before the financial crisis, there was an expected curve. Before the COVID crisis, sorry, there was an expected curve of revenues. And now we have the new projection after COVID, and there is a delta. So there is lost revenue. And what is contributing to that lost revenue? In the short term, more than 50% of the lost revenue is coming from risk costs. So that's where the attention should be. Then there is a small contribution from volumes, but obviously because it's short term, the legacy portfolio still contribute. And then there is a meaningful impact from margins, so about 35%. In the medium term, so we're talking about 2022, 2023, we expect, basically, given what is happening to the economies, that the demand will be impacted, and basically it will contribute to 30% of the lost revenues. Margin to the other 33%, which is expected. It will take some time for interest rates to go up, and risk costs will contribute to other 33%. So there is, I would say, a shift in terms of contribution, and I think also a shift in terms of from a banker's perspective where the attention should be going to. Okay, next slide. And I think the next slide two key messages, right? The first key message is that we expect in 2025 the revenues after risk to be at the same level as in 2019. So there is a relatively lengthy period to go and to go back to the same revenue levels. That's number one. And I think second message is that corporate will be the main contributor on the drop between 2019 and 2021, but also the main contributor in terms of the growth coming after. Sorry, I had someone interrupting. Was there any question? Okay. So I think with this we've reached basically the end of this analysis, data analysis. So Sadi, before we go to the next page, let's stay in the previous place one more second, please. Okay, so if I had to summarize what we just told you, one is there will be an economic impact, macroeconomic impact, and this is expected to be bigger than what we've seen in the past. That's number one. Number two message is the banks are going to this crisis much better position than they were in the past. Number three message is that still there will be a meaningful impact, and profitability will be impacted. But I think fourth, that we didn't cover in a lot of detail, but all our research is showing as well. And if you're interested, please reach out when we can share this research, is that also the fundamentals of the customers are changing. So the expectation from a customer that this crisis will accelerate a lot of the behaviors that were in the making. So not only banks will need to transform themselves to survive the financial impact, but also to benefit from the uptick, we will need to be ready for the new normal and the new customer that will be different from the customer we have today. With that in mind, right, we've put together a list of initiatives that we're seeing a lot of discussion with our clients and a lot of banks starting to take some kind of actions. So, and we separated them in two different horizons. One we called resilience, which is immediate focus, what we need to basically best survive this crisis. And I say survive in a light mode. So I don't expect a lot of banks to be really so seriously impacted that survival is in discussion. But I mean to best cope with the crisis, and then reform, which is where we get ready for the new normal. And we don't expect things to go back to how they were in 2019. So I'll go through very quickly on what we are hearing our clients and what we are advising also our clients to start looking at. Not all of them are doing everything, but most of them are touching in some of these that I'm listing here. The first thing that all banks are doing is really stress testing their corporate and SME portfolio, being very proactive on addressing which are the companies that are hardest hit, finding pockets of growth, because the goal is not to stop lending. And I think government and the regulator doesn't want that as well. So finding the right pockets on where we can continue to have viable sectors and customers is very important. And I think most banks, or all banks I've heard, are doing this in some shape or form. The second is starting to really create quick wins on serving the new distribution mix. Customers have moved to digital, and the likelihood that while we are in this crisis, that they will be happy to go to the branches and do their business in the branches is low. And so being able to very quickly start moving some of the core products to digital as much as possible is a key concern. And here, it's not about digitizing everything end to end. A lot of banks are saying, look, I will leave that to a later stage, but at least being able to to fulfill the customer needs is important. Third is launching cost and capital efficiency and productivity levers. So if you're getting a 30% hit on your top line, you need to find at least 30% in costs, right, to shed out. And obviously, and I think very, very important is that all banks that we've been discussing are doing this, but they're taking into account the humanitarian crisis at the moment as well.
Yeah, so I think I can continue the point, and once he joins, he'll take over. I think he was talking about the cost. So again, there's a lot of focus on reducing third-party cost while making sure people are not affected. I think the fourth interesting measure, which we have seen, which happened early on in April and March, was a lot of budget reviews, right? So bank had a lot more growth strategy, a lot of positive outlook. But I think after this, they really, re-looked at their budgets and made sure they're in the right segments, right customers, and lending to the right people. I think there was also a discussion on operating model. So the lockdown allowed a lot of banks to experiment with, work from home policies, which might stay for a longer period of time. So, for example, call center employees, where, some banks, we know that they have kept them even at homes after, things have become normal, or at least the physical space has opened. So these essentially are, 12 months. I think I would say number A and number C are the ones where we have seen most banks working, and the others, they are, some are experimenting while others are not. When we talk about the longer term horizon, I think there are some initiatives which actually the bank now, since the COVID has initial, stress has settled, there's a lot of focus on relooking at your future operating model. So one discussion is definitely happening on the new digital ventures, digitization at scale, making sure we serve our customers end to end digitally. Either it's on the consumer side, which most banks are doing, but especially on the wholesale and treasury side as well. So there's a clear need for how do we make sure we go back to our transformative agenda of being digital, which we had, back 2 years ago. The second point, I think, which a lot of banks are in the region at least are experimenting. Banks in Europe have, they're operating at scale as advanced analytics. So how do you basically use the data you have either on the retail side, be it all your customer level data, transaction level data, or on the corporate side, be it all the contract level data, all the central bank data, and how do you basically do use cases which help you get more fee business, to Salman's point, which he was saying that banks in the region have done a lot of lending. They haven't really cross-sell much, some banks, and hence the idea is how do I leverage data to open new revenue streams as my top line is getting hit. The third point, which is becoming more and more interesting, is the distribution network, right? What is really the future of branch banking, right? Branches will remain important. We have seen this in Saudi Arabia. We have seen this in UAE. Banks with bigger branches have more market shares. They have better cost of funding. So branches will remain important. No one is denying it. I think the discussion here is, do I need big branches, or do I need like really, small, smart branches, which basically serve my customers in a more digital manner? We have seen some banks in UAE coming with digital branches. I think the discussion is more across GCC that how do I reduce my branch cost, and branches and network is more effective in digital. The fourth point, which I actually is something which is specific actually happening in Oman, is so there's a lot of network which each bank have of their own, the ATMs, for example. How do you create industry-wide utilities that most banks benefit? We have seen in the telecom sector where, telecoms benefit from tower sharing, right? So there's a discussion happening that do we need so much of physical network, specifically on the ATM side? I think another point which is on the whole operating model discussion, that right now there are a lot of dyssynergies in the operating model, where there are structural issues, and if the banks really want to think about cost base, they're thinking about agile operating models. Still a lot more in the experimentation state. We have seen agile in IT, and somewhere in digital, but not across the board. We have seen banks in Europe, for example, ING and others, which are doing a lot more, transformative work on the operating model. I think last point, which I will stress, is M&A, right? So I think this is an important one, right? Because as the earnings will take a hit, some banks will be winner, others will not. Some banks will take more hits, and hence there's a natural case for M&A, which was already work in progress before the crisis. We saw in UAE, we saw in Saudi, we saw in Qatar. It got stalled for a bit, but now we have seen some deals happening, particularly in Saudi. And I think the business case for M&A hasn't changed, right? So there remains a lot more banks than, let's say, the requirements of the population. There are the national companies in the GCC are much bigger than the banks, which means banks standalone cannot fulfill the capital needs of these national companies. Hence, you need bigger banks to basically give capital to these big companies. So M&A on the banking side, and then also to build the capabilities on the fintech side will remain an interesting opportunity. So all in all, I would say from resilience, 1A and 1C are the most likely ones. I think on the reform stage, we're seeing more work on digital, and then a lot more on branches and the M&A. So these are really the core transformative agenda which we have seen. I don't know if Kishan is back and if he wants to.
Yeah, I'm back. Apologies. I don't know, there was some technical issue. But I think, Sadi, I'm sure you've covered it well.
I think we have covered everything. We have 20 minutes. I don't know what, I think maybe one or two points from your side, and then maybe we hand over back to Mariam and Salman for closing thoughts and then for Q&A.
Yeah, very good. Look, I think on the more interesting and new things that we're seeing, I'll just spend some time there. I think on the operating model, there's a lot of innovation going on, and Salman, you might see this coming from a real estate perspective as well. There's a lot of this debate going on in terms of what is the new operating model of the future, and should remote and physical, how can they coexist, etc. So there's a lot of banks and globally doing a lot of experiments with these topics, especially I see in cities like New York, etc., where they're very open to start exploring some of these new operating models. I think that the point D is also really interesting, and we're starting to see a lot of debate going on. It's a very difficult point because it requires a coordination of the whole sector. But I think this crisis creates a great opportunity to create these utilities and things like central platforms for KYC, central platforms for supply chain finance, central platforms for a few industry-wide services is starting to pop up in several markets. So those are the things I would say that are more unique. I think the other ones are just about an acceleration, a very big acceleration of an existing trend that was already here before the crisis.
Wonderful. I think on that note, we'll end the presentation and hand over the floor back to Mariam and Salman.
But I think we are happy to take questions. So if you guys have any particular questions on the presentation so far, more than happy to take.
We will be having presentations post Salman's presentation so that we can collate them all. Thank you.
Okay, super. So thank you, McKinsey, for that really insightful presentation. There's a lot to unpack there, but let me attempt to do the following. Let me provide some perspectives on what's been said, with a particular focus really on the last slide in terms of the transformation agenda. And broadly speaking, the comments that I'm going to make on behalf of the DIFC are going to cover on the resilience side, topics B and C, which is the cost and distribution part, and probably on the reform side for sure, A, B, and C. Mariam, if you could just put the presentation up and running, that would be great.
Salman, do
Hey,
you see the slides
yes.
are up? Yeah.
No, not yet, but that's okay. Are they up? Do others see them?
They're up.
Okay, super. I don't see them, but that's okay. If you could go to the first page.
Yeah.
So look, as I mentioned, I just wanted to give Financial Center, we'll focus not necessarily on the specifics of the sectors, but really to talk about the program for enablement that we are in the process of thinking about. And these link up, as I mentioned earlier, link up to the framework that McKinsey has talked about, both in terms of the resilience in the short term as well as the reform agenda. Look, I'll spend 2 seconds on this slide. This just is a pictorial depiction of a view that we share with McKinsey, which is that clearly this is a tipping point. The financial services is changing. The point of the arrow is not to suggest a decline in conventional finance, but a difference in the rate of growth. Okay, I think that's intuitively right. That's probably measurably accurate. And many of the same things that Kishan and Sadi have talked about are true, which is the importance of going digital, the importance of ecosystems. And we have a unique perspective here because we were and remain an ecosystem that's in the process of aggressively digitizing. So that's very interesting. And of course, data is the underpinning of this entire kind of thought process. So financial services is changing. And we have taken the view that in order to make items such as A, B, and C happen in the reform agenda, that the platform and the enablement for financial services as a sector at the DIFC has to happen. And the future of finance is the way we're going to do it. Next slide, please. I'm not sure if the slide has changed, but I will assume that we're at the next slide. Yeah. Okay, cool. Look, McKinsey talked a lot about platforms, digital. Let me give the audience a flavor for how we are looking at this. Clearly, there are some themes that are directly relevant as extensions to banking, right? Payments, digital banking, Islamic finance, rec tech, and certainly digital assets. Clearly, there is a direct correlation between conventional finance and the pivot to what's next. Let me pause there and tell you a little bit about what we're doing. Clearly, by virtue of where we are, payments is very important. We have new regulations out in the markets. We are the only comprehensive money and payments services regime in the UAE, and that's very exciting and very interesting because it's allowing a host of new, different ways, non-conventional ways, conventional ways of ensuring and enabling wholesale and retail payments in the region and globally. Digital banking, clearly this is in some respects already happening. There we have digital front ends for all the major banks here. And look for this this area to be to come to the UAE very soon. My own view is payments and money services is going to be the wedge that gets us there. Digital assets is another thing, right? Everyone knows that real estate here is our own indigenous asset class, as one example. And clearly, regardless of where you stand in your perspective on the digitization of assets, whether on currencies or not, there is ample room for tokenization of physical assets in order to make those markets more efficient. Islamic finance, again, something really, really important. And I'll summarize by saying that there are a host of other enablers that make these things happen. Platforms are super important. Everyone's talking about them, but for us as a financial center, being able to support platforms that drive the digitization of financial services is super critical for the DIFC as well as for job creation for Dubai. I'll close with one last point on VC. Whenever you have innovation and you have an ecosystem of technology and innovation companies that are serving in the banking space or in the payment space or in the insurance space, the capital, the types of smart growth-oriented capital that you need to support that is really important. And of course, we have new regs that are due in that space, having just completed consultation there. So let's go to the next slide. Okay, so naturally, our journey along the digital continuum into the future of finance started with and remains centrally focused on financial technology, not surprisingly. There's a key message here. There's a lot of data here, but a couple of key messages. One is that we are actively in the process of developing the region's deepest ecosystem in the space. I mean, the numbers change every day. We are north of 230 odd fintech companies with a mix, with a very healthy mix by segment, technology, geography, and clients served. The top part of the screen gives you a sampling of the types of businesses we're seeing. We're seeing businesses in SaaS. We're seeing about a fifth in payments, 10th in wealth management. eKYC, very interesting. I think Saadi talked about the use case for a utility in KYC. Well, we actually launched one publicly with a company called Norblock, which is a DIFC company. And we have a partnership with Mashreq Bank, and we have obviously aspirations for that to scale up at the Dubai level. So conversations there are happening. So that's really interesting. The regulated business will continue to see significant increase. Not surprisingly, crowdfunding was an early favorite when it came to regulated businesses. But rapidly, we're seeing a lot of innovation in wealth management and payments. So the point really here is that fintech, for this particular financial system, gave us that anchor, and now we continue to pivot towards the future of finance and anything that enables the digitization of our economies. Next slide, please. Okay, I'm not sure if the slide has changed. There's a little bit of a lag. The key message here is I'm not gonna go through the details here, but all of the enablement. So enablement happens through partnership. It happens through clustering. It happens through incentives. It cannot happen without the regs. The first 4 or 5 sections up front tell you about how, in a very short amount of time, our regs have evolved. I mean, to begin with, before we even did fintech, right, we had 26 or 27 of the 29 or 30 globally systemically important financial institutions already here regulated. What we now have is robo-advisory, crowdfunding, digital KYC, AML, all that stuff is here. We have new and innovative regulations coming out from money services and VC. And what's really cool is to McKinsey's observation on what's next. We're going to have a view on how to enable this financial markets when it comes to cybersecurity, API usage, open banking. So in the interest of time, let me conclude by simply saying McKinsey's observations on resilience and reform make a lot of sense. We're seeing a lot of the same attributes in our ecosystem. Our own contribution to the discussion as a financial center is to ensure that the resilience agenda and certainly the reform agenda via enablement from platforms to regulations is happening the right way so that we can help drive some of the changes that McKinsey has, for example, talked about as being important for the banking sector. And with that, let me pass the mic back to Mariam, who will now field Q&A. Thanks very much.
Thank you so much, Salman, for that. We are now taking questions. So if anyone from our guests have any questions, please put them in the chat box option. Some questions that we've received for the McKinsey team as well. Is there room for further consolidation given margin compression and weak demand?
Okay. Look, I'm happy to take that question. Saadi, then if you have any input, and Salman as well, feel free to add. Look, I think the belief of room for further consolidation was here even before the crisis, right? I think we clearly have a large number of banks. So far, we had a large number of profitable banks as well, so the urgency for consolidation was not there. Also, I would say that the ownership structure of most of the banks, right, is not that easy to consolidate, especially if the banks have a decent level of profitability. My perspective is that obviously, given the impact on revenues that we are expected to see, and in some cases the impact also on capital, because the risk costs might impact capital for some banks, and raise concerns about capital adequacy, etc. Because what we saw today were average numbers for the market, and for the average bank, we don't expect to see big problems, but there are always banks in the different end of the spectrum. And for those banks, I think, yes, there will be a change in mindset from an owner's perspective, and so we believe that there will be further consolidation in the market, and I think it will just, as I said before, accelerate something that was already a trend that was here before the crisis.
Thank you, Kishan. Saadi or Salman, would you like to add anything to Kishan's?
I think he covered pretty much everything. I think in Saudi we saw a deal being, two banks entered into a merger framework 2 months ago. I think once the COVID settled, they basically announced that. So I think to that point, there will be some acceleration if economically, since the economic conditions are there for this to happen. So, but we can't speculate on anything. We'll see when the time comes.
Thank you, Saadi. Another question is, do you anticipate an uptick in advisory fees such as M&A and restructuring? If so, how do you see the larger banks matching up with specialist advisory firms?
Yeah, I can try to take this because I do a lot of my work in Saudi, so I'll try to take this, which is the biggest M&A market. So I think we saw a lot of loan restructuring. So yes, on the restructuring side, or the debt advisory side, there is a lot of new deals which are coming in Saudi Arabia, particularly, and also given the plans for the debt they need to raise to fund their economic projects. So yes, the demand is there. We have also seen some IPOs and M&A there, so the capital markets demand is there. I think there will always be need for advisors. In Saudi Arabia, if you look at Saudi particularly, we see that there is a demand for advisors who basically can help them bring foreign liquidity in the country. I think that is a bigger demand than we see where advisors can, especially on the liquidity side, can help bridge the gaps between the Asian and the developed markets there. I think in terms of local needs, I think the banks do have their capital arms, which play that role of advisory and restructuring. So that's my perspective on that question.
I would just add one point here, and I would say, going from advisory or restructuring fees to fees as a general topic, right? I think given the environment, we are likely to see, especially the liability side, right, to see a push going towards wealth. Given the interest rate environment we're seeing, the returns you'll get on balance sheet products will be minimal. So I think as a whole, and given the capital efficiency, etc., as a whole, I expect a push from the banks to accelerate the fee business, right? To get more capital efficiency, and second, also to be able to provide more appealing products to their clients.
And we're seeing that trend. So in H1, we saw the fee numbers were up, right? So while there was pressure on the earnings, the fees numbers were up, right? So that is the right observation.
Thank you, Kishan and Saadi. If we seem to have run out of time, if anyone has any question, Salman or Kishan or Saadi.
Look, I
great.
think we are. We just wanted to thank everyone for joining, and also for the DIFC for inviting us to join. And we are available. I think you can reach us through LinkedIn or through the DIFC folks if anyone has any particular questions, anything they want to discuss. Both me and Saadi are available to you, Salman, and or to any one of the participants for a follow-up discussion.
Yes.
Yeah, let me personally thank Kishan and Saadi and McKinsey for taking the time to share their insights with us. We look forward to doing this again when the time is right, always appreciate kind of a fact-based discussion on matters that are important to our community. So thank you again. Really appreciate it.